Hello friends, welcome to another video on business management, accounting and finance. Today we're going to talk about everything about auditing, the complete guide to internal and external audit. Okay friends, so let's see what we are going to learn today. We're going to break down the complexities and make auditing fun and easy to understand. First, we're going to explore what an audit is, why is it important, the different types of audit, and their objectives. Secondly, we're going to the differences between internal and external audit. On third part, which is the fun part, we're going to spend more time is that you will have a walkthrough of the processes of internal and external audit. And then at last, we're going to touch on other important and relevant topics related to audit before we wrap up this excellent session. So let's get going. Auditors are the silent heroes working behind the scenes to protect the interests of stakeholders. Quote, Line E. Turner, a CPA. That was a good one. Okay then, so what is an audit? An audit is a comprehensive examination and evaluation of an organization's processes, systems, or financial information in order to ensure accuracy, their reliability, and compliance with established guidelines, standards, and regulations. Okay, so audit is independent examination of financial records, system, and processes. The question is, why do we need to do the audit? Why we need them to be audited? There are many reasons, and I'm going to list some of the important reasons in here. The first one is transparency and accountability. Auditors promote transparency and accountability within the organization. By examining and verifying the financial records, processes, and systems, auditors ensure that information is accurate, reliable, and complete. This transparency enhances stakeholders' trust and confidence in the organization. The second reason is risk identification and mitigation. Auditors also help us to identify and assess the risk faced by an organization. We do it by thoroughly examining internal controls, processes, and procedures. Auditors can identify weaknesses or vulnerabilities that may lead to errors, fraud, or non-compliance. That takes us to the third reason why we do audit. It's compliance with regulation. Of course, from the previous video you might say, will we have compliance management function? Yes, we do have compliance management function and they perform compliance assessment, but audit is a separate function and they do it an independent examination, independent of the compliance department. So compliance with law, regulation, and industry standard is crucial for any organization, and auditors ensure that the organizations are adhering to those requirements. And the fourth reason why we perform audit, perhaps it's one of the important one, is the financial accuracy and reliability. This is mainly focused for external auditors, but we can also count it on internal audits. Financial audits specifically focuses on assessing the accuracy and reliability of financial statements. By reviewing transactions, supporting documents, and internal controls, auditors verify if the financial information represents a true and fair view of the organization's financial position. This is crucial for making informed decisions. So, you can see auditors serve as a vital tool for any organization. It promotes transparency, identifies risks, ensures compliance, and ensure the accuracy and reliability of a financial information. let's talk about types of audit. We're going to start with external audit. External audit is an independent examination or assurance engagement of an entity's financial statements and other financial information conducted by a qualified and independent auditor to express an opinion on whether the financial statements present a true and fair view according to the applicable financial reporting framework. The primary objective of an external audit is to provide reasonable assurance to stakeholders that financial statements are free from material misstatements and they are fairly represent the entity's financial position and performance. Another objective is to provide an independent and unbiased opinion on the fairness and accuracy of the financial statement. They also need to ensure that the financial statements are prepared in accordance with the applicable financial reporting framework. They also need to detect and report any material misstatements, errors, or fraud activities in the financial statements. And then lastly, they have to assess the effectiveness of internal controls over financial reporting and make recommendations for improvement. Another type of audit is internal audit. Internal audit is an independent and objective assurance and consulting activity within an organization. It's not external, it is within an organization. It's part of the management. It is designed to add value and improve an organization's operations by evaluating their risk management, control process, and governance practices. So, what are their primary objectives? One of the main objectives of internal audit is to assess the effectiveness of an organization's internal controls. Internal auditors examine the design, implementation, and operating effectiveness of control processes. Another one is to evaluate the organization's risk management practices. Internal auditors identify and assess the risks that may impact the achievement of organizational objectives. They work with management to develop effective risk management strategies. And then the last one is improving operational efficiency. Internal auditors examine processes, systems, and processes to identify opportunity for improvement, cost-saving measures, and enhanced productivity. So these were the three main points of internal audit. Okay, so now we're going to talk about the key differences between external and internal audit. The first one is purpose and objective. The primary purpose of external audit is to provide an independent and objective assessment of an entity's financial statement, to express an opinion on their fairness and compliance with accounting standards, while internal auditors focus on providing assurance and consulting services to the organization. It helps improve internal controls, risk management, and operational efficiency. The second main difference is the independence. External auditors are independent and not employed by the organization they are auditing. They maintain an arm's length relationship to ensure objectivity, while internal auditors are employed by the organization and are part of the organization's management structure. Okay, so their independence may be perceived as less compared to external auditors. Another difference is the reporting line. External auditors report their findings and opinion to the stakeholders, such as shareholders, or regulatory bodies, while internal audit, they report the company management, board of directors, or audit committee. Another difference is on scope of work. External auditors' scope of work is limited to the financial statement and related financial information, while internal audit, they have a broader scope encompassing financial and non-financial areas such as operations, compliance, and risk management. Another one is regulatory requirement. In many jurisdictions, external audits are legally mandated for certain types of entities or companies, while internal audit are often not legally required. But larger organizations or regulated industries may have internal audit functions as part of good corporate governance practices. Okay, another one is their opinion. The external auditors provide an opinion on the financial statement, typically expressed as unqualified, qualified, adverse, or disclaimer, while internal auditors they provide reports and recommendations on improving controls and processes, but do not issue formal opinions on financial statements. Another one is legal liability. External auditors may face legal liability for any failure to detect material misstatement in the financial statements, leading to potential lawsuits. That is very hard. While internal auditors' liability is limited to the organization's internal policies and procedures. Another key difference is the frequency. External auditors are typically conducted annually and cover the financial statements for a specific financial period, while internal auditors are conducting the internal audit throughout the year, with a focus on various operational areas, risk assessments, and compliance matters. Okay, so now we have come to our most important part of the video. In this section, I will go through all the processes of audit, starting from external audit. So, as explained in the key difference section, external audit is conducted annually and covers a specific or financial period of a financial statement. For example, usually financial year of an organization starts from 1st of January to 31st of December. External audit engagement is designed in three phases. The first phase is the planning phase, which starts anywhere between October to December. Then comes the year end on January. The second phase of audit starts, which is the field work. The third phase is the completion, which usually starts by March and takes 2 to 3 months to conclude. Don't worry, we will go in detail for each of these phases in next slide. The first step of external audit process is accepting the audit engagements. This is when the auditors and their clients formally agree to work together. The auditors review the client's financial information, scope of work, and any potential conflicts of interest. The second step is identifying the entities and environment. So the auditor dig deep into the organization's operations, industry, business strategies, and any potential risk. This knowledge will help auditors to tailor their approach and focus on the areas that matters the most. Once they got the full understanding, they start doing the assessments of the risk. They assess the risk of material misstatement. It's like identifying potential hurdles on the audit track. Auditors carefully evaluate the risk associated with financial statements to promote their efforts. So this step ensures that the auditors address critical areas with precision. This is also the stage where auditors identify the financial statement assertions made by the management. So we're going to talk about assertions more. So let's have a quick view of them and then come back to our process. Okay, so audit assertions. What is an audit assertions? These are the representations made by management in the financial statements. They serve as the criteria against which the auditors evaluate the completeness, accuracy, and validity of the financial information. The first one is completeness. All transactions and events that should have been recorded in the financial statements are included, and no material items have been omitted. The second one is occurrence. All recorded transactions and events actually occurred during the accounting period. So audit focuses that the reporting transactions and events are genuine and supported by proper evidence. Valuation and allocations. The management asserts that all assets, liabilities, revenues, and expenses are appropriately valued and allocated. So auditors examine the methods used to determine values and allocations to ensure they are compliant with accounting standards and principles. Classification and understandability. The assertions of management in here is that financial information is appropriately presented and described in the financial statements. So auditors will focus on reviewing the organization's financial statement presentation to ensure it's clear, understandable, and follows the certain accounting standards. Another one is accuracy. Management claim that financial information is recorded accurately and there are no material misstatements. However, auditors will perform detailed testing to verify the accuracy of financial transactions and accounting balances. Rights and obligations. Management claim that the organization has legal right to the assets and liabilities, so they represent a valid obligations. However, auditors will focus to ensure that assets are owned or controlled by the entity, and liabilities represent actual obligations. So this is very important one because sometimes companies they try to overvalue their assets and undermine their liabilities just to show a better financial position to their stakeholders. Another one is existence. Management claim that all assets, liabilities, and equities are reported in the financial statements actually exist. So auditors perform a confirmation of the existence of assets, such as inventory and investments. They do a thorough physical verification and other audit procedures. Another one is cut-off. This is very important one. So what happens is that management claim that transactions are recorded in the quick accounting period. So what does mean that all the transactions have been recorded in the correct period of accounting, and in other words, they have not been recorded on cash basis, they have been recorded on accrual basis. So auditors focus on examining the timing of transactions so that they ensure they are recorded in appropriate accounting period. So these were the audit assertions, and by performing these assertions, auditors can provide a reasonable assurance that the financial statements are free from material misstatement. Okay, so now let's jump back on to our process. Okay, so the next step is very crucial, and in this step they have to expect or they have to decide whether the organization's internal controls are reliable or not. So based on the reliability of the internal controls, they can conclude their audit procedures. So what happens is that auditors, they need to perform an examination of internal controls. So if an auditor decide that the internal control existed in an organization are not sufficient or not reliable, or they do not conclude an accurate result, so they will go on a full-blown substantive procedures. It's a procedures like taking matters on their own. They will start from the top of the balance sheet and start redoing everything, recalculating everything one by one. So they leave no stone unturned. So that's only in case if they realize that internal controls are not effective. But what happens if they realize that internal controls are effective is that they rely on the management's internal control. They rely on internal controls, and what they do is they test the control, and they also provide a bit of substantive procedure as well, or we call it a reduced substantive procedures. So either way, auditors are going to do substantive procedures, whether it's going to be a full substantive procedure or a reduced substantive procedures. So let's talk a bit more about these procedures or techniques. What are they and how do auditors perform them? Okay, audit procedures or audit techniques. These are some of the ways that auditors actually use to gather sufficient and reliable evidence. Why they need a sufficient and reliable evidence is because auditors are an independent and qualified firm, and shareholders have appointed them because they want to trust them and they want to trust their opinions. So if an opinion or if a report does not consist a sufficient, reliable and a sufficient amount of evidence, then the report or the opinion itself cannot be competent or reliable. So these are some of the procedures auditors use to ensure the financial statements accuracy, transparency, and on the other side, they also use this technique to build up or generate sufficient audit evidence. Okay, so the first one is analytical procedures. Analytical procedures involve analyzing financial data to identify relationships between trends and assess whether the recorded amounts are reasonable and consistent with the expectations. So next one is inquiry and confirmation. This involves seeking information from relevant personnel, and while confirming those entails, it directs the auditors to get response from the third parties to verify the information. And it's like moving around, talking with every person you know in the organization and outside the organization, like suppliers, major customers, major clients, some of the lenders, so that you get to know and confirm some of the information. Another one is inspection of records and assets. This involves physical examining of documents, contracts, agreements, or tangible assets to obtain evidence. Another one is observation, and this involves direct observation of a specific processes, activities, or procedures being performed by the personnel. And the last one is recalculation and reperformance. This is a very important one, and I have included in the last one as well. It's like doing verifying mathematical accuracy and also reperforming the details of the financial statements that has been provided by the management. So auditors use recalculation and reperformance as a procedure to independently verify the financial information and balances. So these were the audit procedures or techniques. Now let's go and jump back to our audit process. Okay, so now as the audit nears the completion, auditors conduct a final review of their finding. A final review simply means they sit with the management and they discuss their findings, their observations, and they try to get reasons with the management about why and how certain things have been done in the organization. So this step ensures the accuracy and completeness of their audit work, and then they provide a management report that communicates the observations and recommendations to the organization management. So once this stage is completed, once the management report is signed and it's being sent back to the auditors, and what happens is that now all the work is done. Now auditors just need to insert their opinion in the audit report format and then issue the report. So by that, congratulations, your audit is done, and the audit report is actually the result of the culmination of all the hard work. It includes the auditor's opinion on the fairness of the financial statements, and if everything checks out, the report will be unqualified. Unqualified means the report is simply great, nothing big found, nothing concerning found that caused the auditors to report something bad about the management. Anyway, so meaning no significant issues were found. And however, if there are concerns, and if there were concerns, the report may be qualified or include additional explanatory paragraph. So that's a wrap up on the external audit process, from accepting the engagement to the issuing the audit report. And external auditors ensure transparency and accountability in the financial reporting. That's how we do it. Now let's talk about the internal audit process. So whether you are a new internal audit or a seasoned professional, this comprehensive guide will provide you with valuable insights. So internal audit process simply starts with the engagement and the risk assessment. So they do it by having a kickoff meeting actually with the management. So based on the plan that they have drafted before the start of the next year, and you kick off a meeting with the department owner, and then you discuss the engagements, what are the purpose, the scope of the engagement, and you try to get understanding of the organization or the specific department that you're auditing, and then you draft your scope of audit as well at the same time. And then once you have got the sufficient information you need, now you're able to identify risks. Based on the risks, you can prioritize your internal audit plan. So the second stage is the execution, and this is where the real action happens, and the audit team performs testing and gathers evidence to evaluate the effectiveness of internal controls and accuracy of financial records. The execution phase comprises the execution phase includes conducting substantive procedures such as analytical review, testing of details, and confirmation with third parties. Okay, so these were some of the stages of the execution, and by the way, they need to collect audit evidences as well, the same way that the external audit generates audit evidence using the techniques discussed. Okay, so the next one is communication and follow-up. So once the execution of the engagement or the field work is done, what happens is that auditors they need to perform a follow-up with the management about the findings. They review the finding, they share it with the management, and they follow up with the management from time to time. They agree on a timeline that, okay, this is the weakness we have found in your system, and you're gonna have to do it, correct this weakness or mitigate this weakness, this risk, by this date, by 1 month, 2 months, or 6 months, or next year. So auditors follow-up procedure starts from that point. And once the follow-up procedure is started, the exit meeting is also being scheduled, and exit meeting is done with the management, and that will conclude the third stage of the internal audit process. The last one is reporting to board. Now, this is where you highlight the differences between the internal audit and external audit. External audit reports to the shareholders, and internal auditors, they report to the management and to the audit committee. Okay, so that was the internal audit process. Now we're going to discuss some of the important topics related to auditing, and these are very essential topics and key points actually that we need to remember as an auditors. So the first one is professional skepticism. It's an essential attitude. It's the way that audit should be conducted, and auditors need to maintain professional skepticism throughout the audit process, because this attitude will allow them to have a critical assessment of the audit and being alert to the possibility of misstatements, errors, or fraud. Code of ethics. Code of ethics, or some of the professional accountants have a specified code of ethics based on their qualification, but normally code of ethics for professional accountants are issued by the Ethics Standard Board for Accountants, the IESBA, and the fundamental principle of the code of ethics for professional accountants are as follows. They are integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Okay, so the next one is the threat to the ethical principles. So as an auditor, you need to maintain a safeguard of your principles, so that you're not being threatened by some of the influences inside your client's management or other external activities. So you need to ensure that the sufficient safeguards are in place. So the IESBA has identified several threats to the principles that may arise in the context of accounting and auditing practices. So these threats can undermine the fundamental principles of integrity, objectivity, professional competence, due care, confidentiality, and professional behavior. Some of the key threats are self-interest threat, self-review threat, advocacy threat, familiarity threat, intimidation threat, undue influence threat. So these are some of the threats, and let me know how you are being safeguarding your professional code of ethics, and are you following these principles or not? Let me know in the comments. Okay, moving on. Another topic that auditors need to understand is professional judgment. Professional judgment is the application of relevant training, knowledge, and experience in making informed decisions during the audit processes. So auditors are required to exercise professional judgment throughout the audit engagement, and that includes assessing risk, materiality, selecting audit processes, sampling, evaluating or interpreting any accounting standards, and so and so and so. In every stage of the audit, you need to set your mind to this professional judgment, and you need to judge everything based on the competency. Okay, next one is international standards on auditing and an Institute of Internal Auditors standards. Okay, so these are a set of professional standards issued by the IAASB. The purpose of ISA is to provide guidance and framework for auditors while conducting the audit of financial statements. On the other hand, an Institute of Internal Audits refers to the international standards for the professional practices of internal auditing, which are issued by the IIA, or the Institute of Internal Auditors. The IIA is a global professional association that represents internal auditors worldwide. So if you're an external audit, you need to follow the ISA, and if you're internal audit, you need to follow the IIA standards. Okay, so another one is working paper. This is very important. It's a document or a set of documents that auditors prepare and maintain during their audit engagement. They also actually maintain it after the audit engagement. There's a certain requirement by law or by profession to maintain the working paper. It serves as the primary record of the auditor's work, including the procedures performed, evidence obtained, conclusions reached, and the supporting information for the audit findings and opinions. Next one, audit evidence. Okay, this is what we have talked about before when we were mentioning the audit procedures. So if you're performing the audit procedure, you're actually preparing sufficient and reliable audit evidences. So audit evidences are information that auditors use to support their audit opinion. And according to International Standards for Auditing, or ISA, audit evidence must be both sufficient and appropriate. So types of audit evidence include internally generated, externally generated, and audit generated evidence. So audit generated evidence is what we have mentioned before, using the audit procedures. Internally generated evidence or evidences that we have collected from the management, from the personnel, from the staff, from HR, finance, operation department, sales department, accounting department. And externally generated evidences are those which we have collected from third parties, or in other words, they are not prepared by the management. Those documents can be bank statements, a letter from the lenders, a contract copy that we have received from the supplier, and so and so and so. Okay, so another one is audit sampling. And this is very important, and it's essential in every auditor's work. Audit sampling is the process of selecting and testing a subset of items from a larger population of items of data to obtain audit evidence. So the objective of audit sampling is to reach conclusions about the entire population based on the results obtained from the selected samples. So as an auditor, you cannot audit like 10,000 transactions in 1 month or 2 months. It's virtually impossible. So what you do actually is that you create a sampling technique, some way to do sampling. So you either do a random sampling, or you do a systematic sampling, you do a judgmental sampling. So there are some ways to do sampling. So the main purpose in here is that you pick maybe 30% of the transaction, or 40% of the transaction, or 10% of the transaction based on the materiality, and then you go on and do the testing and the audit procedures on those transactions. And because you believe that those transactions that you have selected as a sample are representative of the 100% of the transactions. So that was the key important topics related to audit. And that's why I love audit. Audit is such a accountable and professional field, and it allows you to become more mature in the business environment, in organization environment, because you get to understand all of the weaknesses and the plus points of the organization, and you're actually the guy who monitors everything, and you test everything, you create, you doubt, you challenge the management's assertions, and then you create your independent opinion on these assertions. So it's a really interesting field, and that's why I've mentioned it again. I love audit. Thank you so much for staying with me in this video. I hope you have learned some things about auditing, because I have covered a lot of important areas of the auditing in here. And please do not forget to subscribe to this channel, because it really helps me and encourages me to create more videos like this. And do not forget to like, comment, and share this video with your friends. You can see the name of the YouTube channel and my TikTok channel in here. It's Ferdin Samin, and you're welcome to follow and subscribe to both of them. Thank you, danke, merci, tashakkur.